Hey guys, welcome to another episode of Nonprofit Biz Talk. Today we have with us the home tax biz lady, LuSundra Everett. LuSundra, introduce yourself to the audience.
Hello, everyone. Again, my name is LuSundra Everett. I am the home biz tax lady where I help home business owners win the tax game. We're trying to stay out of jail, y'all.
That's always a good thing.
Yes, orange is not the new black. I don't care what the show says. But I really focus on an education piece where I really help home business owners understand what they need to know to substantiate all of their expenses, claim what they can legally claim, and really legally reduce and minimize that tax liability. That's what I do.
Okay, great. And I like the fact that you kept stressing legal.
Yes.
Legal.
Legal. We don't do
We're not into doing anything shady. Legal. And I caught your live this morning where you were giving a case study of a guy who got audited, and you were saying that, when we sign our taxes, no matter who does it, we sign on that line saying that, under penalty of perjury, we are substantiating that what we have given the IRS is the right information. And if we fail to do that, then we're liable, not the person who prepared our taxes. Yes. So I like that.
Perjury is a felony, just in case.
Exactly. And none of us are trying to go to jail, at least not me.
Yeah.
I'm afraid of tight spaces. So claustrophobia and I are not friends. And that little 8x8 cell, no thank you.
No, you know what though? But even starting with that is how many years have you signed your tax return, whether electronically or physically, and didn't really read that fine print?
I don't think most people do.
Yes. And I'm a tax professional, and I did it too. And when I became a tax professional, and I read that, I was like, shut up. I'm glad I took some time to read. Okay. But yeah, that's just one of those things that you just don't pay attention to. You just sign it and keep going. But that really is what that statement says. And they hold tight to that statement.
Yes, I know. So today, LuSundra is going to clear up some myths and keep us legal when it comes to the nonprofit realm and people donating to nonprofits and what they think they can do and what they can't do and what they should and shouldn't do. And then also there's another misnomer that a lot of nonprofit leaders think that they can hire consultants such as myself, and we as consultants can just write off what they don't want to pay us on our taxes. So LuSundra, take it away.
Oh, I had to hold myself for a minute there. All right, so let's get to this donating of time, okay? Because that's really what we're talking about. Yes. And I have several clients who do partner with nonprofit organizations to help, build community, and whether it's in the arts realm or community activism and all of that. And the one question I get is, how much time can I write off? And the answer to that question is 0. Right? Yep. So what can you write off if you donate materials? So let's say that, if I buy a computer and donate that to the nonprofit organization, if I'm helping them with, some social media or something, and I donate that computer, I can write off the amount of that computer. Okay. I can also write off the mileage that I drive back and forth to that organization. And it's been 14 cents a mile since I don't know how long. Okay. Mm-hmm. But you also have to document that. But if I'm a social media manager by profession and I would charge someone $5,000 for the work that I do for you, that $5,000 is not tax deductible. That is just my time that I have spent with you, and
I think you need to repeat that part again.
Yeah. So if you would, and I also had this with with churches, right? Mm-hmm. Where churches are getting more into the social media realm now, and I have social media managers that attend church, and their church is like, okay, well, you can donate your time. Like, no, excuse me, no. Time is not a donation. You can send them an invoice and they can pay that invoice and they can deduct that as an expense. But you giving your time, that is not a tax deductible donation for that social media manager, consultant, or whatever. No, it is not.
Mm-hmm.
So yeah, please don't do that.
Because we get asked that question. I hear a lot of nonprofit consultants talk, quarrel about that all the time, where, leaders come to us and it's kind of insulting, thinking that we're going to work for them for free and then we're going to wait a year to write it off on our taxes. That alone sounds absurd, but you can't do it because it's not legal either.
Yeah, it's not legal, and you still got to eat.
Exactly. I can't go to the bank on the promise of payment from you or the IRS. I need to be paid for services rendered.
Right. So. Exactly. And so you can donate any materials. And so, I have a client who is a landscape designer, and she helped this new art something or other, landscape, and their land conservationist, everything, all that's great. And, I'm like, listen, you can only write off the materials that you spent. And the mileage.
Did she know this up front?
No.
Or was she under the misconception that she could write off her?
She was under that misconception that she could write off her time. And I mean, I got a text at 8:00 in the morning on a Sunday morning saying, hey, I've done this. How much of this can I write off? I need to book a consult. I was like, baby, save your consult because you can't write that off. And she was like, oh, what? Yeah. So yeah, just understand that no, your time is not a tax deductible expense, period. End of story. I
know there are a lot of people that's going to listen to this and they're going to literally sink in their seats, because I know it's a huge misconception in the nonprofit industry that people think that they can come in, they can, like you said, do social media management, help out with their websites, maybe do some bookkeeping. And at the end of the year, they're going to be able to say, okay, I did 80, 120 hours for this organization, and I can write off, I charge, say, maybe $100 an hour. I can multiply that up, and I have that as a deduction at the end of the year.
And that's
no.
There's there's no way to loop it and swoop it and squeeze it in and all of that. It is specifically no.
You heard it now from the tax expert. No, You cannot do that. Please don't do it. The IRS will come and get you.
Yeah. And the thing about it is that people like, okay, well, and especially in the home business industry, the self-employed people that work for themselves from home, we've got a lot of different industries, and people say, well, there's only 1 in so-and-so chance that you're going to get audited. Well, that's cute until you're that one. Yeah. When you become that one, when you hit that lotto, that ain't a lottery you trying to win. Okay. And so they will come through and they will disallow those things. And then you will turn around and have to pay taxes on whatever that difference is. You will write a check.
Wow.
A fat one.
Okay, so what about people who want to donate monetarily to an organization? What should they know to look out for? And I guess kind of look out for.
Okay, so number one, you have to make sure that it is a qualified organization, meaning that, I can't go and write a check to my neighbor just because they said they have an organization, and then that's going to be a tax deductible expense. You have to, again, the organization part, because if I go give $300 to a nonprofit where that will be tax deductible, but I go give $300 to maybe a struggling neighbor, that is not tax deductible because it's not a qualified organization.
Okay. So before you continue, let me clear something up for people who may be buzzing right now. Like, what is she talking about? So in the nonprofit industry, we tend to umbrella certain terms. Okay. But be very clear that there is a difference between a nonprofit organization and a 501c3 organization. They're two completely different entities. So a nonprofit is a state designation, just like an LLC or C Corp or S Corp or that type of stuff. And usually is not a tax exempt organization. To be a tax exempt organization, you have to be a 501c3 nonprofit organization with a determination letter from the IRS. And everybody, I don't need to say what the IRS is because we all know what the IRS is because we have to deal with them every year, right? And so, yes, so that is the difference. So when we're talking about qualified entity, we're usually talking about a 501c3 organization. I don't know if you want to touch on this too. There's an unincorporated nonprofit association. So this is like when a disaster strikes. So your neighbor's house burns down, and you as a community gather together and you collect funds to give to that neighbor to help them out. At that point in time, you're acting as an unincorporated nonprofit association for that period of time. But the law says that you cannot collect over $5,000 or else you have to file taxes on it.
Yeah. So you do. And, in the spirit of giving, and it's really sad. Okay. Like I have to say this, it's really sad that in the spirit of giving, you got to go, hold on.
Yeah. Am I legal?
Right. Am I legal? You're like, listen, nope. I'm trying to help a family eat. I'm trying to help a family put clothes on their backs. And you really are trying to do the right thing. But unfortunately, in this country, we got laws. So we have to, and unfortunately, the other unfortunate thing is that because there are people that have abused these laws, that's why they're in place. It's not that, Uncle Sam that's the biggest thing. Uncle Sam trying to get money from everybody. No, it is that people have abused these laws. And so the public has cried, fix it. And so, they have to put these laws in place. So it's not, that the government is trying to have their hands in everything. But you know what? When the public cries out, that's what our government is supposed to do. They are supposed to respond. Mm-hmm. And so when it comes down to, different IRS laws and things, that what people have to understand is that the IRS is just doing their jobs. They are the enforcer. Congress is who come up with this stuff. Mm-hmm. And then the IRS has to write the language and enforce that. So, that's their jobs. Right. So when it comes down to the different types of organizations, and even within the 501, I always get that wrong, 3C, 3C, y'all know which one it is. There are still even different levels of deductibility. Yes. Okay. Yes. And that organization, they generally don't volunteer that information. You have to be prudent to ask, so that in the event that you do get audited over your, and your charitable donations are included, you have to know what is a 30% organization or a 50% organization. So there's a lot of things that really go into that. And especially with tax reform, it's really got just charitable organizations as a whole that are like, what's going to happen to us?
Yes.
And so the consumer themselves, the person that's donating, you have to know who you're donating to, what if there are limits or anything like that, so that you can stay on the up and up.
Okay. And so what questions should they ask an organization before donating? What documents should they ask for? And I always tell people, make sure you get your receipt. That receipt should have the organization's name, their tax ID number, their address, how much you donated. If you're donating goods, it should be itemized. You should not be lump sum, like I just donated this box and that's it. And, the organization is not the one that puts the dollar amount on it. You're the one who should do all of that. And you should leave, if you're physically going into the site, you should leave with that document in hand.
Okay, so let me talk about this receipt and the amounts. This is very good conversation. All right. Because girl, you just spoke some truth up in here. All right. What had happened was, what we run into as tax professionals is that, all right, so anything over $500, you have to have a receipt, okay? And there's actually a form 8283, that has to be filled out. I think that's the form number. The numbers are in there, okay? But there's a form that you have to fill out. And yes, your receipt should have that information, the name, address, phone number, and tax ID number. Okay. But what I really want to focus on is these amounts that folks be writing down. You sitting there like, look, the amount of something that you donate, you know, if you're donating used goods, you're not donating what you paid for it. Okay.
Right.
It is what is the value at that time, whether it is a like a thrift store value or something like that. So if you go and spend $300 on a Coach purse and you use it for 5 years and then you donate that bad Coach purse, it is not a $300 write-off. It is, what is that worth now? And it might only be worth, it's depreciated. It might only be worth $25. Nobody cares that you paid $300 for it. It might be worth $25. Okay. And so when you are writing down, you know, how much it is, it's what's the depreciated value now. Okay. And so with that in mind, people are like, okay, the next question is, well, I should just sell the stuff. Okay. And so then you really, at that point, it's a gut check. And this is what I, you know, on the charitable giving side, like now it's a gut check, because see, are you saying, okay, well, I'll sell it and donate the money, or I'm gonna sell it and just keep the money because it's not that much of a write-off. All right. So then, you know, at that point, like I said, it's a personal gut check. Are you really trying to help this organization? You just trying to clean out your
right.
You know what I mean? So, so sometimes it makes more sense to sell stuff yourself and donate the cash than to donate the item itself. Okay. One of the big things we get is cars. Okay. It's like, you know, I donated this car, and, you know, how much of a write-off am I going to get for it? Well, the question you have to ask yourself is, if you sell it yourself, how much can you get for it versus what the basically the salvage value is? Okay. And so, you know, if it makes more sense for you to, you know, sometimes it makes more sense for you to sell the car and donate the cash than to donate the car.
Okay, got you.
Right? Because they're going to sell that car for whatever they can get for it.
Exactly.
And they're going to have to sell it quick. Right? So, so that's the thing that you have to ask yourself when you're donating items, you know, to get the maximum benefit. Would it be better to just donate the stuff or sell it and donate the cash? Okay.
So that's like a personal thing that you have to go through yourself in order.
Right.
Basically, I think that you shouldn't try to donate anything unless you truly want to help the organization.
Absolutely.
It should never be about, okay, what is going to be my tax write-off on this? Like, no, absolutely not.
And with the Tax Cuts and Jobs Act, with tax reform, it really has some organizations shaking in their boots, because they're saying if people aren't able to itemize in the same way that they were, then people are going to stop donating to us. And I said, well, you're going to really figure out who's really trying to help your organization and who is just
just looking for that tax write-off.
For the tax write-off. Yeah. The tax write-off should be something extra, not the reason that you do something. Right. So, like, people are like, you know, how am I going to get this benefit? You know, and I mean, all kinds of things are like, okay, well, bundle your charitable giving, like to your church or whatever. So like, my husband and I are tithers. Okay. Some people believe in that. Some people don't. I'm just using it as an example. Right. And so so the planning thing is to bundle your tithes. And let's say if it takes you 3 years to get to the amount that would get that itemized deduction for you, then you save that up for 3 years and then donate it in one lump sum.
Ah, okay.
So, but I was like, but don't the church got bills to pay for
Okay.
3 years? I'm just saying, I like
Right.
walking into my church and we got drums and lights and chairs and
Right,
stuff.
right.
I
I
like
didn't even
that.
know people were doing that. I
Yeah.
didn't even know that was a thing.
Yeah. So people are really looking at how can they bundle their donations if they can, like I said, put it in some kind of fund. And so when you reach that point where you'll get the benefit, then donate that lump sum.
And is that subject to the amount of income that person has?
Mm-hmm. Yes, okay. There are limits to the amount that you can deduct. It used to be 50% of your AGI. Now it's 60% of your adjusted gross income. That's what AGI is, your adjusted gross income. However, let's say you donate over that amount, then you can carry it forward to the next year.
Okay.
So yeah,
I
so
didn't even know people were out here doing that type of stuff. Like, wow,
well,
people try to find every loophole that there is when they're doing their taxes and giving donations. Like, donations should come, like we just said, from the heart, because you want to help the community. You want to help this particular organization. You have a connection with the organization. Not how can I get some extra money on my taxes? Like, that's crazy to me. Wow. Yeah. That's a lot of thought process.
Believe me, it is, and they're kind of like, how can I make this work? Like, okay, well, try this and see how that work out for you.
Right.
Like, I don't have that kind of time.
Wow. Okay.
In my own life, I don't have that kind of time.
Right.
But yeah, but there are people who are looking at that and saying, okay, so instead of me writing you a check every month, I'm going to write this check and put it maybe in an interest-bearing account or something like that, to where it's liquid, and in 3 years write you a check for, or whatever it is, whether it's
but like you said,
3 years,
every year, every month for those 3 years, this organization still has to survive.
Right.
So then you're really not giving from a selfless place. You're giving from a selfish place, because if you were giving from a selfless place, you would have given that money on a monthly basis or a quarterly basis, so you can truly support the organization.
Exactly.
Madness.
Exactly. Believe me, when I get them kind of conversations, I kind of give that slide. I'm like, I got to keep my customer service on, but I'm giving you that internal side eye.
Wow. Okay. Okay, so another thing that a lot of nonprofit leaders ask me about when they're going to do the ask, right? Because that's the big thing. If you don't ask, you don't get, right? Mm-hmm. And they're like, well, sometimes we get pushback from potential donors because they're saying, well, if I don't give you more than $250, then it doesn't, like we talked about, it doesn't benefit me on my taxes. Mm-hmm. And so is that a true statement, or is that falsity?
It is a true statement. Mm-hmm. Because, like I said, with the itemized deductions, let me explain how that works, and so people will understand. Okay, so you have the standard deduction, which now has almost doubled for everybody. It's $12,000 for single people, $18,000 for head of household, $24,000 for married, filing jointly. That's your standard deduction. Mm-hmm. So if your itemized deductions, when you go through and write off medical bills and all of that stuff within those limitations, mm-hmm. if it doesn't exceed your standard deduction, then your standard deduction is what you get.
Okay.
So unless your contributions are going to, in the case of a married filing jointly couple, unless those itemized deductions exceed $24,000, you don't get any additional benefit.
Okay. So again, it comes back down to, why are you giving?
Yes.
Are you giving for the deduction, or are you giving because you truly want to give to the organization? Right. And I really want to make this clear to people. So please stop harassing nonprofit leaders about, oh, well, I'm not going to get a deduction on that. You have to come from within yourself and determine, why are you truly giving to this organization? Why are you giving to any organization, period? Right. Whether you're going to Goodwill or wherever, why are you giving? If it's just for the deduction, well, you might as well, like you said, go on eBay or Poshmark or wherever and just sell your item and be done with it.
Right.
Yeah.
But donate the cash anyway. And the other question I get too is about business entities, like business entities donating. So when it comes down to sole proprietors, single member LLCs, partnerships, those donations, even though you may donate as a company, it still winds up on your personal taxes under the itemized deductions. You don't get a specific write-off in your on your tax return for that. Corporations have a charitable giving, and I do believe as corporations do, but still, even with the S corp, it still winds up on your personal taxes. So so people were like, okay, well, I'm a single member LLC, and I donated $500 from my company. Is that a write-off for my company? And the answer is no.
Okay. It's a personal tax deduction.
It's still a personal tax deduction.
Okay. So question. So like me as a company, I decide that I want to buy 100 school bags out of my company's funds with supplies and everything. And I'm not going to donate it to an organization. Me as a person, I want to give it out to individuals in the community who I think need to have these school bags. Can I then take that as a personal donation deduction on my taxes, or no?
No,
Okay.
because it's individual. So if you decide I'm buying every kid in my neighborhood a new backpack, right? All y'all, Larry, Curly, Mo, Sue, Jack, John, all y'all come over here, get y'all a new backpack for the year. That is not a qualified organization.
Okay. All right.
You just,
because I get a lot of businesses asking me that question, when they're trying to decide whether they should do something on their own or they should partner with a nonprofit organization. And I've given them the answer that you gave me, but I said, since I have the expert here, let me make sure that I've been given the right answer. Like you need to go to the nonprofit organization, or you need to let the nonprofit organization sponsor your company for that giving period, so that you can get the deduction.
So we get we get a lot of issues with that, because people think, okay, it's charity, I should be able to write it off. And then I get people like, okay, like you hear that such and such $40 million this year, or that organization's CEO made all this money. And so, people are like, well, I'm not going to give to the organization, I'm just going to go give it to the people. Hey, that's great, but just understand, when you go outside the organization, it is no longer tax deductible. Right. And so, and there are people out there who don't care. And those are the people that should be giving. I'm just letting you know. I'm saying that. You should not care. Tax deduction should be a bonus. But if you are looking for that tax deductible part, just understand that outside of an organization, you just know it's not tax deductible. There ain't no two ways about it.
Okay.
There's no looping or no swooping.
Okay. You guys heard it here. There is no looping or swooping. You cannot get around the IRS codes. You just have to stick within the limits. If you're not sure, reach out to a tax professional. Go to your CPA, but don't make costly mistakes. So don't go spending, say, $5,000 buying supplies for your community and giving it out, because I've seen people do that, giving it out, and they're feeling good about themselves while they're giving it. But the ulterior motive was, yes, to have that $5,000 written off on their taxes at the end of the year. And I have seen big blowout arguments, like when I'm sitting down getting ready to do my taxes, and the person's there arguing with the CPA because they're like, what do you mean I can't tax? What do you mean?
And it's very simple. No, you can't. And if you are going to demand this from me, I invite you to take your taxes elsewhere
and go somewhere else. Because there's always someone unscrupulous who is willing to bend and weave the tax code to favor you. But right is right and wrong is wrong. And we're not trying to go to jail. Like we started off saying, nobody's trying to go to jail here.
I'm entirely too cute for that. So that's why I'm like, I'm just really too cute. I am too pretty. for bars.
Exactly.
No.
Exactly.
But you know, but you mentioned that there are a lot of unscrupulous people out there who will do things for a quick buck. But I'm going to tell you that in the end, it really isn't worth it. You know, you might get that extra benefit in the meantime, but in the end, it's not worth it. You know, at the time of this recording, you know, you see Paul Manafort getting straight hemmed up in his case, because guess what? His CPA is now up there telling the truth about everything that he did.
Exactly.
So the CPA is going to serve some jail time.
Mm-hmm.
And so is Paulie Paul. I
Yeah.
would be very surprised if he don't go to jail at all.
Mm-hmm.
So you know, so the thing about it is that even though you might, and what I try to explain, if you have someone that's in your organization that gets ticked off and know that you've done something wrong, the IRS has what's called a whistleblower program. I want people to catch the program part. So there is a standardized way for you to go and report when somebody is doing something foul related to taxes in the organization. And oh, by the way, they get, I think it's 15 to 30% of whatever the IRS collects.
Mm-hmm.
Yeah. So
I can't remember the exact form right now, but there is a form that nonprofit volunteers or board members can fill out, a whistleblower, and that's part of their contract. Well, it should be. I don't know how many people are really giving their board members the whistleblower stipulations when they sign up to become board members, but it should be a part of your board package, because they need to know that if they see something shady going on in your organization, they can safely tell on you.
Yeah.
And think about when you were in elementary school and you always have that tattletailer. There's always one in your organization, and they're just waiting for the right time to blow the whistle on you, literally. Yeah. Literally.
And they will get a reward. Yes.
Yes, exactly. So they'll get a reward.
Yeah. So, you know, so I really caution people, and just, you know, in the management part, especially, you know, like we said, dealing with people's money, you know, to make sure to account for that properly, to make sure that you are donating for the right reasons. And however you do that, even if you do the lump sum payment thing for your taxes, you just need to know what your limits are, that 60% of your adjusted gross income. So, you know, you got to exceed the 60% of your adjusted gross income. And let me explain quickly how that math works.
Okay.
So people really get this. Okay. So let's just say that your adjusted gross income is $80,000. Okay. Mm-hmm. And so 60% of that is $48,000. So let's say you donate $50,000. All right. You'll only get a deduction for $2,000 because it's got to exceed that 60%. Okay. So like you don't get the whole 50 grand. You get
and that's what a lot of people think, that they're going to get the entire $50,000.
You know, I'm sorry, I said that wrong. If you can only donate up to that 48,000, that is your limit.
Okay.
So if you go over that, let's say 50, then that 2,000 gets carried forward to the next year. So that's how that works. That's how that 60% limitation works.
Okay.
All right. It went up 10% with tax reform. So I want to make sure I said that clearly. Mm-hmm. Okay.
All right. Good. So you guys heard it. Like, you know, everything that she's dropping here is something you need to keep at the back of your mind, especially now it's August and a lot of nonprofit organizations are going to start running their end of year giving campaigns. Mm-hmm. Okay. Because we all know, if you don't know, guys, that during the fall season, people tend to have money falling out of their pockets. Usually it's for tax deductions because it's coming to the end of the year and everybody's starting to pull all their paperwork together for, you know, taxes come January. So money starts falling out of their pockets and they're giving to multiple organizations. And they're, you know, but just make sure that you are following, you as a nonprofit organization, you're following the law, and that you're making sure that you give them those receipts. Yes. So they don't have to ask for it. They have to turn those in when they're doing their taxes. And you as the consumer, make sure that you are doing your due diligence and making sure that you vet the organization. You talked about 30% organization and 50% organizations before. Do you want to expound upon that?
So what that means is that there's a limit of deductibility. So there are some organizations that have a 30% maximum deductibility, and there are some organizations that have a 50% maximum deductibility. So if you give $100 to an organization, you may only be able to deduct $30, or you may only be able to deduct $50. So
keep that in mind, y'all.
Yeah.
Keep that in mind. You need to ask these questions.
Yeah.
Ask the questions.
Ask the questions. And the other thing on the consumer side, the other thing I want to say is this. Please stop giving your tax professionals these receipts and telling them to come up with something. That is not our job.
No.
You have to come up with something, because see, if we come up with something, then we become liable. You know, and so no, just no, you as the person who donated those goods, you have to tell us the amount.
Exactly. Thank you for saying, I think we hit on it earlier, but thank you for clarifying it again. So if you donate, say, to Goodwill, you can't tell them Goodwill should not be the one writing down what your items are valued at. That is your job. Do not allow the people at Goodwill to put a value on the items that you are bringing. And like LuSundra said earlier as well, don't bring in your $300 Coach purse that you had for 10 years and then put the value as $300 either, because that doesn't work. Yeah. You know, there is depreciation, and you need to either go online and find out how much your $300 Coach purse is worth now, or put a reasonable price on it. Okay. The value of a used item is not what you pay for it. Yeah, it's not. And for us as a tax professionals, we don't come up with numbers either. No, because that opens us up to liability. So if you get audited, then you're like, okay, well, LuSundra put that number out. No, right. Just no, thank you. So let's kind of wrap up and hit back on some of the points that I really want people to understand about volunteering, especially what they can and cannot do when it comes to volunteering, what they should look for as it goes forward with their taxes. One of the things I want to say about volunteering, you should never volunteer with an organization that does not have an account with the Department of Labor, so that if they're not paying workman's comp for volunteers, you should not volunteer with that organization. That's just my little PSA to you. Any organization that I work with as a consultant, that is one of the first things I tell them they need to do. They need to have insurance for their volunteers, because that's why I always say volunteer is not free. It is not free to the organization. It is a help to the organization, but to the organization, it isn't free. And I want people to stop thinking that volunteerism is free. Because if the organization is going to run an effective volunteer program, they need to have a volunteer manager. Maybe they're a smaller nonprofit organization, so the ED is doing that. That's time, money, resources. I'm all about time, money, and resources, guys. So that's time, money, and resources. The organization needs to have insurance, because if you slip and fall, hey, we live in a litigious society. Let's be really clear about that. Let's be honest. We live in a very litigious society. So you're coming there, I want to help the world. You slip and fall. You're like, you got to pay my bills. I'm going to own this organization. That's just, unfortunately, that's the society we live in. So you need to make sure that the organization has workman's comp, that they're paying workman's comp for their volunteers. So if anything should happen to you on the premises, you are covered, that you can recover some of your, income.
Yeah, absolutely. And so the things that you can deduct your round trip miles. So if you volunteer with an organization, you know, we're talking about the holidays. The first thing that comes to my mind is like the Salvation Army. They have bell ringers. So if you go to different malls or wherever, your mileage from your home to that location and back home are tax deductible. Okay. Your time is not what you would charge if you do what's in your profession. So let's say with me being a tax professional, if I do taxes for a nonprofit organization, my time is not tax deductible. The only thing that would be tax deductible is the paper that I printed the tax return on. That's it. Okay. So any items that you donate to the organization. So if you buy, you know, a lot of plants, okay, if you only use 3 of those plants for that organization, then you can only deduct the amount for those 3 plants because you kept 2. Okay. So whatever you give completely to that organization, you can't say, well, I bought this computer to put here to do work here and then take the computer back. No.
That's a great point because I've seen people do that. They bought a computer for, a lot of times it's the founders. Mm-hmm. So they get disgruntled when they're terminated by the board, you know, so they brought in office furniture, they brought in computers, whatever, and they've been writing it off on their, they wrote it off on their taxes as a donation to the organization. And because they're disgruntled when they're leaving, they're like, well, I'm taking my stuff.
Well, then you need to amend your taxes to take that donated amount off. Okay. Mm-hmm. So it has to stay with the organization. Okay. If you're going to deduct that. And yeah. And so if you have if you have an employee that goes to if you send them to work there, because you're going to have to pay that employee anyway, mm-hmm. and you can write that off. But if you don't pay that employee, you can't write off their time. Okay. Okay.
So if I, as a business entity, send an employee to work at the organization during regular work hours,
right?
Not as a volunteer, but as a staff member, I'm donating my employee to that organization for X amount of hours, and I'm paying the employee, I can write that off.
Right. Because you're writing off salaries as a deduction anyway. It's not a bonus. Right. It's not a twofer. Like okay. I deducted here on my payroll and I'm deducting it as, as volunteering or charitable deduction. No, it's not a twofer. You're going to be paying them anyway. So yeah. So during work hours, absolutely. They're just working there. It is what it is.
Talking about that, there's one other thing. I can't believe I'm forgetting that. 1099 employees or 1099. Is it 1099? Am I saying it right? The miscellaneous. Yeah.
Yeah.
So that, please touch on that when it comes to nonprofit organizations, because I've been in some back and forth telling them, no, you can't do that. If they're coming in and they're working regular hours from 8 to 5, Monday through Friday, they're not 1099 employees. They have set hours.
Okay. So what had happened was, all right. So this is the difference between an employee and a 1099 contractor. What you cannot do as an employer is decide, okay, well, I don't want to withhold taxes, so I'm going to pay you as a 1099 and let you do your own thing. Mm-hmm. That is not it. The IRS has tests for that. And they're basically control tests. Do I control what hours you work? Do I control how much you get paid? Do I control the training? Do I control the tools? An independent contractor, the only thing that we do is direct the result, right? So if I hire a contractor to do graphics for me, I'm directing the result. I have an idea of what I want, but I'm not telling them how to do their job. I'm not telling them when to do their job. I'm not telling them what training they need to do. I'm not providing the training for them, any of that. Okay. So I'm not telling them how much I'm going to pay you. You decide, as I'm coming to you for graphics. Okay. It's going to be $50 for this graphic. I got a choice to pay it or not, right? They set their own wages. So as an employee, if you have that kind of control, that is an employee, you need to file and withhold and submit the employment taxes. The people get the withholding part right, but they don't get the submitting part right to the government. Okay. That's the truth. And you have to pay them on a W-2. It's not optional.
Okay.
And you
hear that, guys. It's not optional.
Yeah,
because
you can get in hella trouble for that.
Right. Smaller nonprofits don't want to go through the, red tape of paying employment taxes and all of that stuff. So they're hiring people as 1099 employees, but that person has to, and I know I'm saying employees because that's what they really are. Yeah. They're working from 8 to 5, like I said, Monday through Friday, and they're giving them a 1099. And a lot of people too don't realize that they're even, I don't know why, because I've seen it happen, but I don't understand the logic behind it. They didn't realize that they were a contractor and not an employee. So when the nonprofit organization tells them, oh, well, we're going to have to lay you off, they then go to the Department of Labor to file for unemployment, and then they're getting a shock like, nobody paid unemployment for you. And that's when they're realizing that, wait a minute, I never had tax deductions, I never had, whatever taken out. So and at tax time as well, when those 99s get issued and you've been paid, $25,000 for the year, and $25,000 isn't a lot of money, but when you got to pay taxes on say $25,000, then that becomes a lot of money. Yes. Because most people don't have that money saved up. They're living from paycheck to paycheck, and that whole amount that they're getting paid on a biweekly basis is going into paying bills. They're not thinking about taking out 30% or 28% to hold over for paying their taxes. Exactly. So yes, and the thing that's on the IRS streets now is that the IRS is ramping up their what's called trust fund recovery. They're going for people, and it's generally small businesses that are the biggest offenders of this. They're going for people who are collecting, they're withholding those employment taxes, but not submitting those employment taxes, but they're also going after people who should be paying people as employees, but they are paying them as independent contractors. It's against the law. Got you. Yeah, so that's why I said it's not optional. Okay, so I, as a business, and I think I heard you say this in one of your lives. I can't remember exactly what you said, but I was listening. Yeah. You were talking about 1099s, and you were saying that the person who hires a contractor also has some type of form that they need to turn into the IRS too? Well, they need to collect a W-9. A W-9. There you go. Right. That was what it was. Yes. Go ahead. Yeah, they need to collect a W-9 and not the W-4. So if I hire you as a contractor for my company, so you're going to be my my CPA, my bookkeeper, whatever it is, I need to collect a W-9 from you. Okay. Yeah, you can't, and people get wrapped up in this. Well, if you're paying me by credit card, then you don't have to do this. If you're paying me by PayPal, listen, you can't over collect W-9s. You won't get in trouble for issuing a 1099 to someone that you really weren't supposed to. The IRS is like, okay, whatever, this is just extra paper. However, the flip side is if you don't. Okay. Yeah, the don't part, that is steep, right? So depending on how many 1099s you didn't issue and all of that, that you were supposed to, because we do have that. We do have that where people are, and this is across the board. It's not just nonprofits, but it's, all different types of small businesses that are paying people what's called under the table. Okay. Yes. So when you get caught, if it's a blatant disregard, that fine is in the millions. Okay. It can be up into the millions. It just depends on how much money you're making. Right. So yeah, you can't over follow the law. Okay. All right, great. This was great information. Like, I know some people are going to be sitting there going, oh my God, did she really say that? Like, I thought I could do this. Nah, she's got to be lying. No, it can't be that way. But yes, guys, it is that way. She is a tax expert, and she's telling you from years of experience and taking all those hard tests, because I know those tests are not easy to become an EA. They're not
Ray
easy
is not smarter than
all. Yeah.
Ray and the street committee are not smarter than me. Like, I am not the sharpest knife in the drawer, but I know who the dull ones are, and they're the ones.
So I would employ anyone listening to this to go back and listen to it a second time and take notes. Take notes and make sure that you are following the law to the letter so that we don't have to come visit you in jail. And I don't come to jail to visit anybody anyway, so.
And I ain't putting no money on nobody's book.
You're going to be all the way on your own, okay? I'm not coming to visit you. So, LuSundra, tell the audience about any programs and services that you have and where they can find you so that they can start using your services.
So you can find me, Home Biz Tax Lady. I'm on Facebook and YouTube. Those are my usual hangout spots, but I'm also on Instagram and all of that, Twitter, whatever. But my email address is homebiztaxlady@gmail.com. Find the Home Biz Tax Lady. You will find me. I will be starting a webinar starting in the fall. I'll be holding webinars monthly and just covering different topics, and especially leading up to tax season, helping people get prepared. And so, just reach out to me on one of those arenas. Get your questions answered, you guys, because it's that one question that you don't ask that's going to land you in hot water. So you can definitely book I offer a 15-minute complimentary consult. If it's going to take longer than that, I'm honest with you and I'm going to tell you. And you can take what you heard here. If you have a tax professional or a CPA, great. Take what you learned here, go ask them. Okay? Go ask them about, if this is a concern for you. So definitely invest the money to talk to them, because what you invest now is going to save you later.
Yeah. All right. Well, thank you, LuSundra, for being my guest today. And we greatly appreciate all the nuggets that you dropped.
Thank you for having me. It was my pleasure.
You're welcome. Hey, nonprofiteers. Thank you for watching another episode of a Nonprofit Biz Talk TV. Remember, there's someone in your community waiting for the help of your organization, and it is your responsibility to make sure you get it right. Don't forget to like, share, comment, and subscribe. Until next time, bye-bye.